seems to be working. Everything is fantastic. Let's get this show on the road. Haha. All right. Well, we've had a kind of crazy day so far. A bit of up and down action in the Nasdaq, but it seems to be deciding to go down. As I said this morning, we should be testing the 16,000 line from the top, and just generally part of it's I mean, part of a weakening trend, and it's also that we didn't pull back. It's very simple. I mean, if you look at these charts, there it is. Here's Nasdaq. You know, when you get these uninterrupted runs and they go on too long, like 14.5 and 10% brings you to 16,000. So you got like a 10% run without a pullback. That's problem number one. Problem number two is 16,000 is significant, although 15,000 is more significant. And I would argue if you go to like a longer term chart like this one, that we've run from Nasdaq 10,000 to Nasdaq 15,000 and overshot the mark without even a significant pullback. Just this little consolidation. You know, here's 12.5 basically. You have a bit of a pullback, which is a halfway point, and it came all the way back to 11. All right, which it should have for sure. But the Nasdaq is really very big on the 5,000 line, so you look for action around there. And it finally broke over 5,000 here. I think then quickly went to 10,000 though. I mean, really not. You know, this is freaking 5,000 we hit in 2017, and then we're at 10,000 in 2020. You know, testing it in 2020 early, getting over it for proper in 2020, and then 18 months later, not even, we're at 16,000. We've doubled in half the time it took us to double last time, and the time before that it was 19. You know, we were at 5,000 back in 2000. So we didn't double this in the double. This is just getting back to where you were. Then we double in 4 years, but now we double in 2 years, and then we double in, and then we go. Then we double in 4 years, and then we're at I'm sorry, not double again, but another 5. Then we had another 5,000 in 18 months. It's crazy. We will double in 4 years at this rate, but we won't because, again, reality. It's like housing prices. The price of a house, a normal house, average house, median house, whatever you want to call it, but the price of a house has to be sold to the family of a person who makes a family income. So the average family income in this country is, I mean, it's just math. Okay, so we say not average, let's say median, because median family income. 55,600 is a median family income. The average family income is probably higher because some families make so much money. No, it actually says the same number. Well, it says median, that's why. Average family income. All right, well, there's no easy answer apparently. I'm pretty sure the average is higher. Oh, there you go, 67 something. That's saying median incomes. Anyway, so let's pretend real median family income. Well, the Fed, see now the St. Louis Fed thinks you earn 80,000 bucks. So they got their own statistics. But let's say the average family makes $80,000. The average family makes $80,000. Fine. So it's $80,000. Whoops. So it's $80,000. Let's do that. Minus taxes. Okay, I don't care how many deductions you have. You've got to be paying 20,000 in taxes. I mean, that'd be crazy low, right? So let's say it's 20,000 in taxes. Okay, so minus, and now you've got your 1.5 kids, right? And let's say, how much you going to get away with kids? I can't imagine how you're going to get away with less than $1,000 a month on your kids. You know, you got to feed them, you got to get them to school, you got to buy them clothes. Let's say $500 a month. I want to just be like crazy low. So let's say $6,000 per kid So let's say $9,000 for 2 kids. That's your child expenses. Then you've got your own expenses. That's going to be another $9,000, right? You're buying food for yourself, buying food for your kids, and so on and so forth. So there's that. Then you've got to you got your electric bills and gas bills and furniture bills. So let's say you're spending $1,000 a month on home bills, okay? And that's going to give you your disposable income. So your disposable income is 60 minus 10 is 50, minus 9 is $41,000. So let's say, and again, we are being super generous to say that the average family's got $41,000 of disposable income to spend. Now, if, oh, I'm sorry, you got to have a car. No, let's say they don't. Let's say there's not even a car involved. Let's say, and of course, you're not saving any money. You got no insurance. You got no nothing. You didn't do anything proper, but you got $41,000. Well, that turns out to be only $3,000 a month, doesn't it? And that's if you do nothing else in your life and you don't insure anything and you're saving no money. A family, it starts with $81,000, has $40,000 a year to spend. And of course, this is, as you can see, bullshit numbers that you don't really have that much money. But if you were incredibly careful with your money and didn't spend anything, didn't subscribe, didn't have cable, blah, 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 you got $3,000 a month left to spend on your dwelling. But that includes taxes. What if there's taxes? What if there's property taxes? And then once you have the home, don't you have to fix it up or do something with it, and so on and so forth. So you're backing into, at most somebody can afford is maybe $2,500 a month. Maybe $2,500 to $3,000 a month is what a person can really afford on a home. Now, you take your interest rate, you take that amount of money. Where's your deposit coming from? God knows. Where the hell are you going to get a deposit out of all that? So there's a number, and that number is $2,500 to $3,000 a month is going to be available to spend on a home at the most. And therefore, we now have, since we know what the interest rates are, we now have a maximum housing price. And maximum housing price is roughly $400 and something thousand. Okay, once the average housing price goes over $400 and something thousand, economically, it becomes unviable. So the answer, so when you look at a chart that shows home prices rising from 250 to 350 to 400, right? Then it doesn't mean you can't extrapolate it. Average home price chart images. So then when you see in thousands, what the hell number is this? Canada, US average home prices. Well, look at Canada. Canada's out of control, but is that because it's in Canadian dollars? So here, Southern California. So Southern California, hopefully they have higher incomes, but they're at $500,000 for home sales. The median price. I guess the median price is different than the average price. The median home values. That's where you're going to see some real stuff. So you're talking about 350, 400. But the point is, just because you see something going up on a line like this, it doesn't mean it can keep going like that, because you hit a certain level where people physically, mathematically cannot afford the home. Doesn't matter what you say about the economy or what you say about the opportunities or the unemployment or this or that, they can't freaking afford it. There are things that price you out of the market, and there are limits to how much money people have. And especially when you're talking about things you sell to lots of people. If you want to talk about beachfront homes, that's totally different, because you're only selling beachfront homes to a certain segment of the population. And the percentage of homes that are beachfront homes, I wonder if that's a statistic. What percent Age of homes are beachfront. That's pretty interesting. Oceanfront, Florida, waterfront, do not buy oceanfront property, no shit. Looking for a beach house, it'll cost you, New York Times. 2-bedroom share, waterfront property, 46. Waterfront property is 46% more than inland property. Economics of buying a beach house, blah, blah, blah. Okay, anyway, so let's just say for a stretch that 1% of the homes in America are beachfront homes. Well, obviously, you're selling into the top 1%, right? They cost 50% more than regular homes. There aren't as many of them, and only the wealthy people can afford it. But those people aren't in the median income. You know, income distribution U.S. So if we look at, what are we looking at? Okay, so there are each thing is 500,000 households, each full house. So just making sure, no, this is 2005 anyway. So here's, oh, here you go. So here's the median, here's the average. The average is significantly over the median. Why is that? Because the people up here earn ungodly amounts of money that you can't even calculate the amount of money these people have. There's 112,000 households, or however many households are total. There's 112,000 households below $250,000. They didn't even calculate these guys. 98% of the houses make less than $250,000. The top 1%, the top 2% make over $250,000, but so much over, some of them, that they skew the whole chart. So in other words, 2% of the people making over 250 bring 98% of the people from 46,000 median to 63,000 average. A 50% increase in everybody else. So that means if we kill these people, we can give 50% more money to every single person on this chart. Keep that in mind when you're discussing policy. But anyway, so these people can't afford a house at all. And so these are your renting. This is your renting population, if they can even afford rent. And then you've got the homeowners who range from the 50 to 150 range, whatever. And I was talking 80, right? That's the I was saying 80 was the average. We were being super generous. People are making 80,000. The reality is very few people make more than $80,000. But anyway, so the point is that it creates a finite number at which home prices can go to, and the same is true with stocks. The same is true with everything. It's you have to look at the total population of purchasers and what they can afford. And when you start talking about $100 trillion market that goes to 110 trillion, 120 trillion, $200 trillion, you can't say they're going to double again. Where is the $400 trillion going to come from? You've got to understand the underlying basis of what it is you're selling, and that goes for copper prices, gold prices, so on and so forth. You know, in any given year, for gold, let's say, in any given year, there's a certain demand for gold. So let's get back to FinViz, if we can find that. Here we go. Okay, gold. Metals. All right, so at $400 from 1998 to 2005, for 7 years, gold was under $400. Okay, then gold climbed up, flew up to $1,200. All right, so this is a massive, massive increase in gold. Massive increase in gold. It flatlined at $1,200 for quite a long time. I mean, it did spike up above, and then it came back down a little, but basically it held around. It held the $1,200 line. That was the next one. Consolidated here, moved up aggressively again to 1,800, and now it's consolidating 1,800, which we expect, but ultimately should probably go up to 2,400. And some of that is inflationary if you compare it to a dollar chart over the same time. You can see what happened to gold. The dollar went from 120 to 80, and now it's flirting back at 90, but it's still 120 to 90. That's a pretty significant drop in the dollar. So that then is part of the reason that gold went the way it did. And it's not just the dollar. That's the thing. There's other currencies like the euro. Okay, now the euro started off there. I mean, the euro recently has gone down considerably. The yen, especially in the last, in the last bunch of years, in the last few years, last decade, basically. Look what's happened to these currencies. The pound. And Brexit is over. This is a whole, panic about Brexit and then actual Brexit, but meanwhile it's still weak as hell. Canadian dollars useless. Aussie dollars. Okay, who's holding up? Swiss. Swiss are managing to keep their currency. In fact, the Swiss artificially depress their currency. This would be much stronger, but they buy all these other currencies to try to keep their currency from like dominating everything because they don't want a super strong currency. So they work on keeping theirs weak. So point being that gold is enjoying quite a rally, and silver too lately. But gold is actually, more reliable for that sort of thing. So, and then you've got Bitcoin coming out of nowhere and being $3 billion, whatever. 3 trillion, sorry, 3 trillion. Bitcoin is now $3 trillion. Other cryptos are another couple of trillion probably. So you got about $5 trillion in cryptocurrency now. The brand new asset class that didn't exist, literally didn't exist. It was created out of nothing and it sucked up $5 trillion. It's pretty amazing. But that happens when you are printing money, when the government is printing money like crazy, you're able to do these things. And I had that. Where was that chart? La-di-da. It wasn't yesterday. Was it Monday? No, it wasn't Monday. Maybe it was Monday. Let's see. I know I talked about it recently. Oh, there it is. Yeah. No, wait, what's this? Oh, that's stocks PE. That's not it. I had a really nice chart of the money supply. It wasn't that, and it wasn't this. There it is. Look, that's the money supply. So this just happened. We had the virus, money supply chugging along. It actually alarmingly had doubled. It's funny how we were concerned that the money supply had doubled from 2008 until 2020. That was already a concern, or 2019. We were already saying, geez, look at the money supply. It's out of control. They doubled it in the last 10 years, like coming into 2019. Because when we had the other crisis, the money supply used to be $2 trillion. In fact, I still talk to people today, which is funny because people I work with who are savvy financial guys, they still have that 2 trillion number stuck in their head. They don't understand that we left $2 trillion in circulation behind ages ago. Because people say to me, I don't get it. How could there be all this money in Bitcoin? How could there be all this money here? You know how? Because we took the money supply from $4 trillion and 2 trillion in 2008. We took the money supply and we put it from 4 trillion to 20 trillion. But did we increase the amounts of goods and services that are provided in the economy? No. It's just excess money. It had nowhere to go. It had nothing to buy. We didn't increase our imports. We have a little worse of a deficit, but not significant. But we didn't increase our imports, and we certainly didn't increase our economy. The economy's been, nowhere for the last 2 years. Net nowhere anyway. Obviously we have a big increase over last year, which was horrifying. So all this is just money sloshing around looking for a place to go. So where does the money go? Cryptocurrency. It's got to go into some currency. And as we just saw, all of the currencies look like crap. So the money goes into gold, the money goes into crypto. The money doesn't go in, well, to some extent, it's gone into real estate a bit. But the thing is, you have to understand how much money this is. Because when you buy a home for $500,000, you only put down a $50,000 deposit, and the bank puts up $450,000, and it's not cash. They write that as a reserve loan, and it immediately gets taken care of by the Fed, basically in the repo market. So effectively, you're just creating new money when you do this. When you buy a home, you're giving the Fed and the banks an excuse to create more money. They take 10% of your money and they extrapolate your payments over X years and whatever, and they create the money on their books and the ledger and say, okay, we're receiving this much from this guy and we're paying this out, and then they roll it over into some other loans, and it just all sort of disappears into the system, the obligations. And what they've done is created money. That's why the government pushes housing. It helps them create money. So we have had a big boost in the housing market, but nowhere near enough to suck up trillions and trillions of dollars. There's only 100 million homes in the U.S., and if each of those homes was $1 million, that would be $100 trillion. But they're not. So let's say each of the homes are, $250,000, so it'd be about $25 trillion worth of homes. And we can probably get an answer to that anyway. What is the total value of all U.S. homes? 31.8 trillion. There you go. See? So at back of the envelope calculation gets them every time. And yeah, I can see that because not 100 million homes, 110 million homes. And of course, some homes, just like everything else, some homes are real freaking expensive, and they skew the number. The average home is not the price of a home. But anyway, so it's not 250,000, it's 268,000, blah, blah, blah. So I could accept that number easily. So the total housing market is $31.8 trillion. That means, though, that if you wanted to buy every home in America, which of course doesn't happen because we're only turning over 1 million homes a year, but if you want to buy every home in America, then you only need $3.18 trillion to do it, because the banks are going to fund the rest of it. It's going to get funded. So it's not the M1 money supply, then the M2 money supply. The wider money supply gets larger. What's that? I love charts. What's this chart? Total value of all homes in the U.S. Ooh. Oh, I see. It's a Giphy thing. GIF or GIF, you decide. What's happening here? What are you scaling? Don't scale. That's wrong. See, they just a scale makes it meaningless. Look at California, man. Wow. That is interesting how California, there's no way to stop this, is there? Stop it. All right. Anyway, so it's very impressive that California is such a gigantic portion of the total home market. And they're probably 10% of the population, but this is way over 10%. All right, stop that. It's annoying me. You're just going to click on it. All right. Anyway, go away. So what do we say? 30. Anyway, the point being that if the Fed created, there you go. So if the Fed created all that money, which I've now lost that chart, but you know what I mean. It was here. Okay. So if we created $16 trillion of new money, and it would only take $3 trillion to buy all, Swiss 7. So it would take this much to buy all of the houses in the United States. What the hell are you doing with the rest of the money? Got to go somewhere. Can't go into real estate. It's full. Even if you did, yeah, again, we don't turn over that many houses, but even if you did turn over that many houses, then there's corporations, corporate borrowing was a couple of $1 trillion, And the corporate balance sheets have increased their debt by a couple of $1 trillion, and then they've, of course, projects and things like that, and the rest is just money to be put in different places. And so some of it goes into gold, some of it goes into oil, some of it goes into this. People have to put the money somewhere. There's money. What are you going to do with it? You know what that's like. You can't have money sitting around. You know that if you have $10 million in your savings account, every time you go to the banker looks at you like, what's wrong with you? Why are you doing this? Why aren't you moving your money? What are you doing with your money? Why are you not doing this? Would you like to talk to somebody? You like have a mental problem if you have cash in the bank. So, you gotta think about where this money is being placed. And of course, money managers don't make any money if they don't put it into something. So it's all going to be put into something. And that's where you get inflation, though. When you start printing money, you're going to get inflation because people got to put the money into things. And eventually, yeah, it gets put into stupid things like bigger houses and yachts and this and that, and then buying things, and people start competing. And again, we're not creating more goods and services, therefore more money gets paid for the goods and services we already have. It becomes an auction problem. We're not creating a bigger labor force, therefore you're paying more money for labor. The same labor, more money, you pay more money. The competition for the labor increases and people have to pay more for the labor. That is the only good thing about inflation. It's actually good for the people at the bottom. Once you get wage inflation, it's an actual beneficial cycle for the labor, for the workers. But unfortunately, it takes a long time. Wage inflation is the last thing that happens. In fact, wage inflation is when the business class, when the conservatives suddenly go, oh my God, I'm paying more money for labor. Somebody stop the madness. They don't complain when the stocks are going up. They don't complain when the housing's going up. They don't complain when the bond market's crazy. None of that is going. They don't complain about any of those things. That's all fine because they can make money on that. But when you tell them they have to pay their workers 10% more money, then it's a crisis. All of a sudden, everybody's got to stop this inflation thing from getting out of control. And that's where we are now. We're at that point where inflation is the big problem, and the polls are saying inflation is a big problem. Plus, we the people are feeling it at the gas pump, and we're feeling it at the supermarket, and so on and so forth. We're feeling it at Disney, where they're now charging more than $125 a ticket. I want to say 150. Disney Day. Come on. Disney Day Pass. Not a Florida. Disney World theme park tickets in Orlando. La da da. Park tickets. I don't know. Anyway, it was a very large number last time I looked. If you're a Florida resident, it's only $109 a day. Standard theme park ticket, all guests. Well, wait. $109 a day, Florida resident. Standard theme park, $109 a day. The longer. Oh, 1 day. No, 1 day ticket. I don't know. I'm confused. Okay, I swear it was more than. I don't think that's accurate. Explore options for your Disney World visit. So one park, if you want, I see, I'm confusing. It's a park hopper. If you want to go to more than one place, in other words, if you stay in the Magic Kingdom, it's only $109 for the Magic Kingdom. But if you want to leave the Magic Kingdom and go somewhere else in the same day, it's $65 more to go to the other park, which is complete bullshit. And plus, now you can't even go see. Now it says after 2 p.m., you have to be in one park until 2. Then you can go to the other park after 2. Park reservations required. Oh, it's such a hassle, huh? Anyway, inflation. I remember when they used to have those ticket books. Freaking craziness now. I think it was free to go into Disneyland. You just buy the tickets for the rides, like a carnival. Anyway, So things have gotten expensive, and people are complaining. It's killing Biden in the polls. Yeah, I forgot how much people hate inflation. Biden inflation poll. "57% of Americans disapprove of Joe Biden's handling of the economy." Can you believe that? 57%? Oh, that didn't help. Damn it. If it tells you need an ad block, you can go to incognito mode. Where's this? It says to be California, right? San Francisco, 450. Yeah, you paid $100 to fill up your tank. You're pissed at somebody. The average hourly wage is up 5% from a year ago. The S&P is up 40% since Joe Biden was elected a year ago. 40 market's up 40%, and they hate him because of the inflation, though. That's why. It's so funny. The S&P is up 40%, and 60% of Americans disapprove of Biden's handling of the economy. Why? Because they don't benefit from this at all. But the people who are in the market and made 40% are not complaining about the 5% increase. It's not they're not worried about that. 75% of Americans rate the current economic indications in the country as only fair. 75% of Americans rate the current economic conditions as fair or poor. 33% say poor. 42% say fair. 33% say worse than fair. 68% say the economy is worsening. Inflation and economic concerns are outpacing worries about COVID. These are terrible, terrible numbers. Yet the market is at record highs. We are crazy people. We are crazy, crazy people. But I'm telling you that you got to be concerned. Oh, the oil has my S&P. Oh, look at that. That's very nice. So we're getting a bounce off of 46.50, which of course we're getting a bounce off 46.50. I'm not terribly inclined to like even take these off now. I'm telling you, because I think, you know, I'm waiting for the really big drop on S&P, and these are the ones we were playing last week, although I've been in and out of a couple. But got a nice little gain there, so don't want to like let it fade away. See if there's any questions. All right, nobody has any particular questions. That's lovely. So anyway, so the point being that there's a level, and it's hard to figure out exactly where the level is because things, you know, it's not an exact dollar amount. I can't say there's only this many trillion to spread around because the banks take the money and they multiply it out, and then it becomes a much larger amount than you think, and it's hard to tell what sector things go to. And obviously wealthy people are moving money around, but that's what I'm saying. The real economy that 75% of the people live in, they think it sucks. But you and I don't come in contact with those people very much. Okay, most of you guys who are in the investing class, right? We're at least in the top 10%. A lot of you guys are in the top 1%, top 5%, something like that, 2%. You saw that. I mean, household income, $250,000. You're in the top 2% of the country. You might not feel rich, but you are rich by anybody else's measure. Only 2 out of 100 people make that much money. You know, and even when we talk about going to Disneyland, when I talk, you know, when I think Disneyland, and all of you guys have gone to Disney with your kids, yet I speak to so many people. It's amazing how many people have never gone to Disney, and it just blows my mind. My kids, you know, now, I mean, they're in college now. They're not as interested as they used to be, but every single year we went to Disney. Every year. It was just a thing that you do. And for me, you know, it's people have never gone, and now they can't even afford it. Now it's not even a thing that people think about doing, because it costs $1,000 a day to take 4 people to Disney, basically. You know, between the park tickets and the hotel and the food, it's $1,000 a day vacation. That's nuts. That's not affordable. And you know, and some of that's inflation, and some of that's just corporate greed. It's the money that these companies make now off these things, and of course the shareholders and the board of directors want more. They say, "Where's the next? How are we going to make more next year? Oh, let's raise ticket prices again." And the math for Disney is Disney. I predicted this a long time ago. We talked about this based on this math. I said this is what's going to happen. Disney. Total attendance, I want to say 2021, attendance at the park was 6.9. Magic Kingdom increasing visitor numbers each year. Attendance 2020. Most visited theme parks worldwide. All right, so here you go. The Walt Disney World, what is this number? Why are there two things? Well, it doesn't explain itself. Oh, there you go, 2019. Okay, so 20 million people at Magic Kingdom, 11 million at Shanghai. You got to watch all the different things. Animal Kingdom 13. So let's say we're at, I'm confused already. Let's say we're at 14, and what do we say it's going to be? 14, 11 is 25, and 21 is 46. And we did that one. 46, and I'm going to call it 56. Then we got another 60, 70. Ooh, that's a lot though, isn't it? Happy Valley. And 11 million. And some of these are redundant, you know, some of these people are hopping, so it's not the same thing. But what I say, where we get to 80? So let's say we're 100 million people roughly at Disney. All right, so 100 million people a year go to Disney, but there are 8 billion people on the planet. 8 more divided by 100. Whoops. What the hell? Hit the wrong key. 100 equals 80. So only 1 in 100 people can go to Disney. And that's, by the way, though, that's not really the same thing, because these people didn't go for one day. They go for multiple days. So let's say the average person goes for 3 days, right? So now we're going to multiply. So we multiply it by 3, that they're there for 3 days. And now it's 1 in 240. So not the top 1%, but the top 0.5% of the people in any given year can go to Disney. And in other words, if you can live 240 years on this planet and never go to Disney. That's basically how it's working right now. They can only have 100 million people. And that means during your lifetime, 10 billion people will go to Disney. But if that would be if everybody went one time to one park for one day, then everybody on the planet would get to go at some point over the next 100 years. But that's not the way it works. What happens is rich people, like my kids, go in their lives, I'm going to say conservatively, 5 times 20. I'm going to call that a conservative number. They've been there 5 days for 20 years, basically 100 days have been taken up by my kids. And me and my wife, and you know, so, and we usually bring friends of theirs with it, but that's, I know the people, so that counts. But the point is, these guys are way overusing it comparatively. And that's the problem, though, is because the people who are wealthy, who can afford to go, they'll go again and again and again. And Disney will just keep raising and raising the prices because they can't take any more people. They can't make any more. And also the economics of a park are such that there is no benefit to Disney. In other words, how would Disney serve it? How could Disney drop their ticket prices? If Disney said, oh my God, this is horrible, we have to figure out a way to give people $50 tickets. How do we cut ticket prices down to $50 for people and make this more affordable? Well, I guess if you want to have the same revenue, obviously you would double the amount of people who can come to Disney. Therefore, you double the size of the parks. But is that going to be worth it? Are they going to spend $20 billion making new parks bigger, or making the existing parks bigger and spreading them out and adding rides? But then what about staff? Then you got to add staff. And if you're adding staff, you're adding expenses. So you're on a hell of a curve. It's a very slippery slope just to get even with where you are now, because you're adding expenses. Everything you do is an added expense. So in other words, if I'm trying to get my ticket prices down to $50, I need twice as many people. But then I need twice as many rides, and I need twice as many people working on twice as many rides. That means I now need to make the same profit. I need another 30% more people. So I really need 3 times more park space and 3 times more people. And hopefully I can budget this and budget that and do this and do that, all just to keep up with where you are right now in profits. It's not going to happen. Not a doable thing. Even if logistically you have the land space and everything else to do it, it's not a realistic goal, is it? So they end up bottling themselves into this sort of trajectory where it only makes sense to cater to the wealthiest people. And in fact, if you look at the Star Wars hotel, this will show you what they're catering to. Star Wars 2-night adventure. It's some shocking price. Are they even going to tell you? Highlight, prepare, start planning. Let's see. Booking, what's included. Blah, 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 blah. Plan your voyage. Look how fancy, huh? It's like that's a great, because they tell you you're staying on a spaceship, therefore they give you a crappy little room, and you're like, oh great, a crappy little room, and you got a little space window. Oh, here you go. So wow, this is per night. Okay, get this. 2 guests per cabin, $1,200 a night. $5,000 for 2 guests. That's the real number. They break it up nicely to make it seem not so horrifying. $5,000 for 2 people to do this. $6,000 for a family for 2 nights. This is for 2 nights. So book now. Next year, it's coming. And they're going to be sold out because there are people who spend that kind of money and don't bat an eye. You know, it's either this or going to space that week, so they'll figure it out. This is who we're catering to now at Disney, though. When they build a new hotel, they have absolutely no intention ever of seeing people who are below the top 1% in this hotel. It's not even aspirational for people to be able to do that. 6,000, I mean, maybe a once in a lifetime, and that's the problem, though. Unfortunately, people will do that. The same people who do these once in a lifetime cruises are like, oh, we spent $6,000 on this cruise, and we took 2 weeks here or a month here, and blah blah blah, and it was worth it. Blah, I'm in debt forever, but whatever. Yeah, people will do it, but realistically, it's just not affordable. But they don't care. They can't care. It's not even, and I don't want to say they don't care. Somebody cares, but the problem is it's not economically feasible to help to do this for people who don't have scads of money. And that's what our society is becoming more and more and more, is everything is behind a rope. Oh, Disney used to have a fast pass, right? And it was very, it was fair. I would say it's a very fair system. The way the fast pass used to work, you get into the theme park, you've all got passes, and what you do is you go up to a ride and you book a time at that ride. So the ride you want to go on most next, you go to that ride and you book a pass. Now, you can't book another pass until you use that one. So when you're done with that one, you can then go to your next favorite ride and book that. And generally, I think you could probably do, I would say generally 3-4 hours. So if you were there for like 12 hours in a day, which most people were there like from open to close, but if you're there for 12 hours, you're going to get at least 3 or 4 chances to use your fast pass. So 4 rides that you really, really want to go on, you're going to get to go on at Disney because you use fast pass. Well, they killed that, and now you know how you get on a good ride. You know how you get a line with a fast pass. You pay extra. So now, if you want to not wait in line for 2 hours or 3 hours to get on a ride, you pay extra. And it's all crazy. It really is. And again, it's not Disney. I'm just saying Disney because I think everybody's kind of had that experience. You know, it's just you know, it's now it's just this incredible money suck, and it's very sad. It's sad because I think kids should get to do that. I think it's like it's almost like it should be a right for children to be able to do this once in their lives at least. Go to Disney World and see it, and enjoy this place. You know, where do you get this kind of entertainment? Where do you have a place where kids like everything they dream about when they're young, especially? All the stuff they dream about and all of this, it becomes like a reality for them. It's so great. But anyhow, so point being though, sucks to be poor. Very important point. Keep that in mind. Because it sucks to be poor because it's all like abstract stuff if you're poor. Look at this. Look at that. I hope there's 2 beds. I don't know. What do they got? Oh, a hairdryer, a safe, voicemail, a TV, H2O plus spa. Wow, that sounds amazing, right? Oh, I see. 2 queen beds, 2 bunk beds, and 2 wall down beds for 1 adult each. What? Oh, that's a grand captain suite. Oh, wow. I'm sure that's not what they're talking about. They're talking about a standard cabin. Standard cabin doesn't have that. Oh, here you go. Queen bed, 2 bunk beds, and a wall pull-down bed. If sleeping 5. So there you are, sleeping. You got a view of your parents sleeping over there. Perfect. It's like a ship. It's like a cruise ship. So funny. Man. $5,000. So anyway, bottom line is you get to a limit where people cannot afford more. And that's going to be a problem for these guys too, because how are they going to make more money? Are they seriously at 10% inflation? Okay, if they raise their prices 10%, it'll be $5,500, $6,000, $65,000, $7,000. Then you're almost jumping up to like $8,000, $9,000, $10,000. So in like 10 years, these things will be $10,000 a cabin. Not even 10 years. For 2 nights, $5,000 a night to be at the Disney hotel. So how much a wage is going to have to increase before that's palatable? Remember that budget we did before with the $80,000 person? When are those? Now, $80,000 for a family of 4 is not a terrible amount of money. Sure as hell ain't minimum wage. When are those people ever going to go to Disney? When are they going to? And obviously, Disney doesn't just mean the Star Wars hotel, but the reality is, like I said, it's $1,000 a day to go anyway. So, going back to what I was saying, there's a limit to how much money builders can charge for houses. There's a limit to how much money Disney's going to be able to charge for people. There's a limit to how much Tesla can charge for their cars. Now, Tesla's a little different because what Tesla can do is make more cars that cost less money and sell it to more people. They can do that. Apple does that, right? Apple makes more phones for less money or more, well, I'd hardly call it less money, but you know, considering what's in them and whatever. But Apple hasn't gotten to that stage yet. Apple is just starting to move to the stage where with the iPod, remember the iPods, they got better and better and better, and then all of a sudden they started releasing cheaper versions. And then everybody on the planet had iPods. People had multiple iPods. They were so cheap. They were like $50, $60, whatever they were. And people were buying pink ones and blue ones and green ones, depending on what kind of mood they were in. Apple's going to do something similar with phones. There's going to be inexpensive Apple phones, especially for the rest of the world, because Apple's basic attitude is saying, well, okay, right now we're selling 1 billion, 2 billion phones to the top 20% on the planet. You know, those people are buying the phones. Everybody else is not buying iPhones. They can't afford them. Although it's, and I know it seems like in America everybody's got an iPhone, but you know, we are in the higher range on the world as far as what we can afford to spend on things like that. You know, in India and Africa and places like that, there are not a lot of iPhones flying around. So Apple wants to sell to everybody, and especially with the Apple Pay system shaking out, they're still experimenting with that stuff as far as Apple Pay and things. They'll make more money on Apple Pay than they'll make on the phones. You know, it'll become your credit card, and if it's going to become your credit card, they're going to make little tiny phones that serve the primary function of being Apple Pay units. Yeah, you can communicate, but the main idea for them is you whip it out instead of your wallet, you whip out your phone for your ID, for your credit cards, for your health monitoring, and all that stuff. So that's what Apple's expecting down the line. And it'll be interesting when Tim Cook retires to see who they replace him with, because he's going to be stepping down in the near future. And it'll be interesting to figure out what direction they're trying to take people. But Tim Cook is the guy that did that with the iPhone, came up with all those lower cost substitutes. Not the iPhone, sorry, the iPod. You know, the iPod mini and all that stuff. So, oof, wow, look at that. See? Glad I kept those S&P shorts. Very nice. Okay, good. Oh, here's 16,000 being tested. Now, if this fails, we could be heading straight for 15,000, because that's the next real support is 15,000 on the Nasdaq. So that could be kind of ugly. So let's see. Clay says, what's your opinion of Teladoc? If this is a company you like, at what price would you consider it to be a buy? Look, where are they? Here we go. You know, do I like Teladoc as a concept? Yes, I like Teladoc. Do I like Teladoc for $22 billion? No. It's too expensive, and that's why I never talk about it, because I'm not it's sucker stock. There you go. To sum it up, it's a sucker stock. All right. He started putting on these things. Some of them are really funny. I like that. They IPO'd here, roughly. So their history starts here, $17 a share. Okay, that's what people thought they were worth at the time. They went quite a long way, a whole year, and they doubled in price basically. They went to $30. Now $30, we're at, what are we at now? 120, 140. So $30 is a $5 billion market cap, let's say, from where we are now. So are they worth $5 billion? Are they even worth $30? Well, got $2 billion in sales. They don't make any money. They're losing a couple of $100 million, but you know, they could turn it around. When they had less sales, they were losing less money. Now they have more sales, they're losing more money. but they think they're going to turn this around. So let's say by this year, they drop it to no loss in 2023. Then let's say they turn it the other way and they make 200 million, 400 million, 500 million, whatever. They still got to make $1 billion before they're going to justify 22.9. So we're looking into 2027, basically, before they're even close to justifying this. Look at the operating profit, right? That's not a good trend. Net profit, not a good trend. EPS, not a good trend. Well, it's all going to be the same like that. So you can see that your operating margins. I mean, oh, no chart. Why did I get no chart? Oh, there it is. Operating margin, no, not very exciting. So the thing is, yeah, it's a great idea. It's probably the future of medicine, but will they be the ones that win in the end? Okay, what does Teladoc do that's so unique that IBM is going to kick their ass and other serious companies? You know, you can be first to market with this kind of stuff. You know, with this online stuff, you can be first to market, but it doesn't mean you're going to win. It's like I've always said about 3D printers, okay? Hewlett-Packard is not big on 3D printers, even though they are by far the world's leading printer company. Why do they not make 3D printers? And it's because there's not enough market for them. It's not worth it. When there's a market for them, they'll make them. But there's no reason to make them for a hobby market, which is all it is right now. So for the amount of stuff Teladoc is doing for their $2 billion worth of business, IBM is actually very heavy into medicine, but they're going in a different direction and working with the hospitals first on the higher levels, whereas Teladoc is working on the basic doctor to patient level. It's a runaway value. That's all there is to it. It's just I don't see how I would pay that kind of money. I hate these. I wouldn't pay this kind of money to be in the space when I don't even know if they're going to end up winning. What they've done so far over the last 5 years is lose 5, 6, 7, 8, 9. They lost. Sorry. Yeah, that's right. 5. They've lost about $1 billion over the last 5 years. Now, that's not terrible. You know, for an ambitious startup and blah, 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 it's not terrible. I'm sure they've got the money. They're not going to go bankrupt or anything. But it's nothing exciting about this. It's very early to invest and you're making a big gamble. Look at Beyond. Now, we played with that for a while. Why? Because we caught it at the right time, though. We played it because it dipped. And we got ourselves a nice entry that was back at the IPO price. If this ever shows up. There it goes. When did we come in? I don't remember. We must have come in somewhere around here. I don't know. It says all. It's not really showing you all. I guess they must have IPO'd around here, and we came in around here. We came in, we took this dip. It was getting back towards 50, I remember. And I was like, well, I'll pay 50 because the 50 was where they started. So I imagine we must have come in around here on Beyond. But we got out when it went to 150 because it's stupid. And now it's back to 100. And when it gets back to 50, we'll like it again because that's about the right price. These guys weren't wrong when they went to the IPO. And Beyond is another company. And what I was saying today, in fact, we were talking about that today in the post about people don't understand and politicians don't like to talk about it because everybody's like, oh, the oil companies have to do this and that. It's like, no, you know, our habits, our bad habits are causing more than half of the global warming. Our poor habits, the way we don't use public transportation, the way we do eat environmentally damaging foods, especially meat. It is absolutely insane to eat meat. 8 billion people cannot live on meat on this planet. It is bad. We are causing a lot of global warming because of the fact that we eat way too much meat. So same problem here, even less revenue, but honestly, I don't care about the revenue. I care about the losses, right? Because they're losing. How much money are they losing? They're losing a couple $100 million. Not so bad. Okay, but this year they're ramping it up. They're losing $100 million this year. Going to lose 45 this year. Same story. They'll hopefully break even maybe in 2023. Maybe they'll break even. Okay, sales are going up. But the thing about these guys is they are absolutely the future, although, again, there's plenty of companies. But the meat industry is gigantic. And we must replace the meat industry with something like this. We cannot keep eating the meat. It has to stop. It's not sustainable on a planetary level. We can't keep doing this. So I like the story of Beyond better than I like the story of Teladoc, because Teladoc doesn't have to be the future, and Teladoc can have infinite competition. So I mean, so, you know, and obviously Beyond can have infinite competition too, but who's going to get a foothold? You know, and Teladoc doesn't have a sort of a moat with patents and so on and so forth, while Beyond does. Beyond has a lot of patents and a lot of processes that they're going to keep them give them an advantage for quite a while. It'll be interesting. It'll be interesting to see who really prevails in this stuff. You have Impossibles and you have Beyond, and there are new companies coming to market that they're going to have stuff too. But the bottom line is, we've all got to learn to love this shit. So you should start, you know, you guys should start eating these Beyond burgers. Big talk from me. Big talk from me is last week I was telling you to sign up for Kobe beef. But if you're going to eat a cow, eat a really good one. That's the bottom line. That's how I justify my sort of two-sided approach to this thing. But no, it's like we all have to learn not to eat meat. That's the bottom line. We really do. It's terrible for the planet. It's an environmental disaster, and probably immoral. I mean, if you think about it, you know, killing animals for fun. It's not for survival, because we could survive without eating the meat. So we're not killing them for survival. We're killing them for fun. And I'm the least vegetarian person on the planet, although I had a girlfriend who was vegetarian back when I was in college, and for an entire summer, I hung out with her for a whole summer, and I ate no meat for one whole summer, which I was very proud of myself. But then I went right back to eating meat after that. But I did learn to appreciate vegetarian cuisine. Really, I actually really enjoy it. But so the thing is, you know, this is the future. These are trends that you look at and say this has to happen. Same thing goes with SunPower, which is still in the running for our stock of the year for next year, because this is now. This has to happen now. And they're not particularly low or anything like that. They're actually, you know, up on late 30 again. Damn it. Nope, they're going to get knocked out of the running if they stay up here. It's going to be too expensive. But SunPower, I think, is just ridiculously cheap. And again, here, now you'd say, no, it isn't, because it's really got a pretty high PE. It's $5 billion. And they're not even making $100 billion. They're not going to make $100 billion. These guys are trading at over 50 times earnings, more like 70 times earnings. But the long-term potential of this, I think, is huge. And I also think that these are grossly underestimated revenue numbers, because it only takes one contract. That's the thing. Their size is what makes them attractive. They're only $1 billion in revenues. It only takes a $500 million contract from the Pentagon with $100 million in profit in it, and all of a sudden these numbers get blown out of the water. And everybody thinks they're the hottest thing since sliced bread. Is that enough of a catalyst, though, for me to make a bet on them to be the best? You know, and again, stock of the year for us doesn't mean it's the best performing stock of the year. It means that it is the most likely stock to give us a 300% return next year in an options trade. So is this more bulletproof of a trade than whatever else we look at, than IMAX, for example, which I think is now no longer cheap? This is what happens to me. Like stock of the year. We have all these great picks for stock of the year, and then they start getting expensive again. Yes, the IMAX is popping back over 20. And IMAX is only $1.2 billion. $1.2 billion. They're not making any money this year, but next year they should go back to 40. And if you look at the revenue numbers, they're right back to where they should be. And they're going to make, at some point, they're going to make $100 million a year for sure. They'll keep growing and they'll make $100 million a year, and you're going to own them for $1.2 billion. So why don't you want that? It's almost inevitable growth, but there's no particular near-term catalyst for it to happen. But as a long-term investment, yeah, okay. They're going to keep making more theaters and people are going to go to those things. That's a good investment long-term. That's something that's going to be a trend in film watching. In fact, think about it more and more. It's like, I know personally, if I'm not going to go out and see an IMAX movie, why am I going to go to the movies? Why do I need to go to a movie theater? What's the point? Unless it's going to be a big production that I feel like seeing. And there's also an IMAX home TV. Disney is reformatting all their home stuff into IMAX also. So you're going to have a better experience at home, but it's still going to be IMAX, more licensing fees, more revenue, so on and so forth. So how's the market doing? Oh, holding up, bouncy, bouncy. I really should cut these back to 2. I should. I think I'm going to put a stop up here, 46.50. Let's do that. So here's 46.50. So we put in a buy order because these are shorts. So 46.50 we buy one, and 46.52 we buy another. So we're putting a stop on half of them if we go up there. If we keep going down, then God bless, let it go. All right, because I'm not going to blow these profits. These are insane profits. And oil, we'll see if they bounce, but I don't really care. I'm not going to play all. Now it came down already. It's not worth playing up anymore. How's the rest of the charts look? How's gold? Ooh, look at gold came way back down, huh? When we hit 1870 and came back to 1850. And silver went over 25. That's interesting. The 25 offered no support. That's an interesting thing to pay attention to. Just like 1860 offered no support here. So it might not be as strong as you think it is, these guys. Ugh. All right, what else is going on? Oh wait, probably has more questions. Let me see. If S&P heads back up, when would you stop out? Aha, I just answered that question. So I'm stopping half out at what did I say? 48.50. So I'm sorry, 46.50. So 46.50, I'm stopping half out, and one at 46.50, one at 46.51. And if it keeps going, then eventually I'll drag that stop. That stop will drag down to 25 at some point and drag down a little bit lower. You know, I'm still playing for the big dip in ES, so I kind of want to always have something on, and that's why I keep like playing with these things and renewing them, because I want to have something on. And as you can see, today was a really good day. Obviously, there's 4 of them for 6,800. But I'm just playing. I think there's going to eventually be a big fall. And here, we'll look at the Nasdaq here. This is also a good time to check the 5% rule. So we've no, wait, I need a better chart. Let's see. I'm tired. Hours. All right. So obviously we've got some serious support here. So let's call it 16.4, 400.4, right? From 16.4, we're going to ignore the spike above it, and we're going to call it 16,000 is where it's resting down. So 400-point drop means what? 20% of 400 is 80, and let's just round that up. And I would call 16.1 the weak bounce and 16.2, or really 16. Well, it's 80 points. It's really 16,150. So the points I'd watch is 16 I'm still going to go for 16 because it's round. So I'm going to say instead of 80, I'm going to call it 16.1 is going to be the first weak bounce. So basically, if we're not over 16.1, then we don't consider it any kind of bounce at all. It's not worth getting worried about. And until we get to 16.150 is technically would be obviously the 20% line, 16.160 exact. But 16.150 then would become what we would consider a real bounce. And until we're over 16.2, we're not going to really pay attention to it. It's still not that strong. See, if it comes back to here and looks weak and comes back down, all it's doing is confirming that this whole gap over here was wrong. But for now, we're going to consider that this is all correct and that we should have been 16.4. But so 16,000. And by the way, I believe that's a 2.5% line, right? Because if you do calculator, so 16,000 times 1.025, 16.4, right? Okay, so 16.4 is the 2.5% line over 16,000. So obviously that was going to give you some resistance anyway. Now we pull back 2.5%. Next stop obviously is going to be 400 points below this 15.6, and you can see 15.6 used to be support. So if 16,000 fails, you're looking at 15.6 as the next stop. All right, and fails doesn't mean for a second. It means if it really fails, if you start moving significantly below that. But 15.6 could be the next stop. But the point is, for a bounce, we're looking for 80-point bounces. And you can be exact about it if it makes you feel better. So it's going to be 16.080 is weak and 16.160 is strong. But basically anything under 16.2, I'm going to consider it still to be pretty weak. And then below this, though, if this starts failing, then we're looking at 15.6 is going to be the next stop on the Nasdaq. And that's some pretty ugly stuff. Then if you look at the S&P, since I know what the Nasdaq is doing, I can assume the S&P is going to do the same thing. We'll be at down around 4,500, 4,600 range, whatever. I don't even have to do the calculation. I can see the segments are basically similar. And the Dow, and for the Dow, we'd be getting down around here too, about 30, probably. Here, this looks like a more significant line, right? So we'll be looking at like 35.7 on the Dow. All right, which isn't far, it's only 300 points, so it's not going to really impress anybody if the Dow falls 300 points. So that's interesting, actually. It's the same thing with TSM. Why are we going to look at TSM now? You know, I don't know. It's not the same thing. I don't see how Teladoc and TSM are the same. Is it a company I like what I consider to be a buy? I guess that's what you mean by the same thing. No. I don't know what's going on with chips in Taiwan, with shortages, with supply, with their constraint for the shipping. You know, it's tricky. And then you've got the whole Taiwan situation with China to worry about. There's too many moving parts to start playing with TSM. I'd rather go with Micron, which is a little bit easier to digest as far as, you know, seeing what they are, seeing where they stand, having an idea of what's going on. So if I'm gonna, and also a way bigger company, I would prefer playing in this space. They've got bigger cash reserves, and they're $84 billion, but they're making $10 billion a year. So very well worth $84 billion. So I would rather go with Micron and rather hold up with them for the long term. Micron's headquarters is where the hell are they? They're in U.S. somewhere in Idaho. So they're in the middle of the country, and they're a good solid company, and I feel better about being with them. The logistics are a big problem. We don't know when that's going to get fixed. Really, the shipping's a problem, and with Taiwan Semiconductor in particular, you got China's basically getting ready to go to war over this. China wants Taiwan, and they're no longer just being cute about it. For many years, they've been cute about it, saying, oh, Taiwan's part of China. Ah, those silly Taiwanese with their independent government and blah, blah, blah. They're like, we're letting them play for now, just like they let Hong Kong play. Okay, they're the way the cat lets the mouse play. They're like, they'll sit there and they watch it and they let it run around, but eventually they're going to get bored and eat it. And that's what's going on with Taiwan. That's what already happened to Hong Kong. China got bored and ate it. It's gone. Hong Kong has only the illusion of being not part of China now. It's completely been co-opted by China. And the same thing is going to happen to Taiwan, except it's going to be a bit more of an incident since the Taiwanese people are separate, really, they're separated by water from China. And there's a lot of countries who have an interest in not seeing this happen. But in reality, you know, if America had a claim on, well, we do. America has a claim on Puerto Rico, of course. It's technically a state, but not really. It's a state to everyone but us. We don't consider it a state. But to everybody else in the world, Puerto Rico is considered a state of America. But if we had a claim as such on Cuba, and we wanted to occupy Cuba, it's the same thing, right? It would be an incredibly difficult thing for Russia or whoever to stop us from annexing Cuba because it's right next to us. It's 90 miles off our shore. It's very hard to stop you from taking something that's that close. We would have to send our Navy to the other side of the world to protect Taiwan and then fight over what? How popular is that war going to be? How are you going to explain to the American people why we have to protect Taiwan from China? People can't even tell them apart. Things are made in Taiwan, things are made in China. That's the only difference. So anyway, so for those reasons, TSM is certainly not going to be on my radar for that. Then Dave says, with today's jump in gold, should we look at selling some calls? Yes, you should look at selling some calls. Will I sell some calls? No, I will not. You know, the jump in gold is just the jump we expected. It's a long overdue thing. There's gold, and here's gold. Okay, so this gold has gone like that, and this gold has gone like that. But the thing is, notice how bottomy this gold is all the way back at 18 from 22, let's say. So it's down, let's say, 20%, or it was down 20% at the bottom, and now it's down halfway, which is more like 10%. This gold was down, what would be 20% of 2000? 1,600. In other words, if this had gone down 20%, it'd be 1,600, and then halfway back would be 1,800. So we're more than halfway back, and we never went as low as gold did. Now, in the stock gold, there's a leverage issue because the question is, if Barrick Gold, the other gold, if Barrick Gold is making gold and it costs them $1,300 an ounce to pull out of the ground, then at $1,750 they make $450, right? At $1,850 though, they make $550. That is significantly more money. It's 20% more money on a 5% move up in gold. They make 20% more money. So there's the leverage. But on the other hand, when it came down, they make 20% less money on a small drop in gold, another 20% less money on a small drop in gold compared to last year. Then you got to go back to this chart and say, well, okay. So in other words, what were they making? And they were making in 2019 $4 billion. And last year they made $2.3 billion. Now they're making $2 billion again. So the projected price that they see is going to give them 2.059. Now, if you read their annual reports, they are projecting gold stays around $1,700, $1,750. So the thing is, what do you think is going to happen now? If you think gold is going to be more than $1,750, they're going to make significantly more money than they project. I think gold is going to pop 2,000. And that's huge leverage for them, because when you get to 2,000, again, if it costs them $1,300 an ounce to pull it out of the ground, at $1,750 they make $450, but at 20 they make another $300. They're making 75% more money than they made. And by the way, if you look at the price of gold in 2019, when Barrick Gold had a fantastic year, where's that thing? In 2019, when they made $4 billion, gold was only just climbing up. It has never been cheaper since. Now, part of this money is not profit just from gold, though. You have to really tear these things apart. Part of the money is because they sold mines and made some money and so on and so forth. They also acquired Goldcorp, though, and that's why you see the revenues are going up, but the profits are not, because they acquired Goldcorp, and they're still in the process of sort of like sorting that out. Barrick Gold's advantage here is having the lowest cost extraction in the business. And what they do is they acquire all the assets of a miner, and then they sell off all the mines that they don't want. Now, a mine Barrick Gold doesn't want, let's say produces 50 million ounces of gold, and at $1,000 an ounce, it's like $50 billion worth of gold or something like that, right? 50 million times 1,000 is 50 billion, right? So let's say, for argument's sake, well, it wouldn't be 50 million, it'd be 5 million or something like that. But so 5 million ounces of gold makes $5 billion in revenues. So Barrick says, okay, great, but this mine produces $5 billion worth of gold, and it's at $1,500 to extract. We don't want it. They don't want it because it's not a low-cost extraction. Their strategy is to have the lowest cost extraction. It doesn't fit their extraction profile. Meanwhile, gold is pretty much going to be over $1,500, and almost anyone knows that. So if you are looking to buy a gold mine and you say, oh, I could buy this Barrick mine, it's going to make 5 million ounces of gold, and it's got a $1,500 base, and oil's going to and gold's going to be $1,700, I'm going to make $200 an ounce. So I'll make $10 billion. No, $200 an ounce. Sorry, times 5 is going to be $100 million. So you'll extract 5 million ounces of gold and make $100 million. You know, and again, just roughly numbers, whatever, it doesn't matter. Or $1 billion, whatever the hell the number is. But you as a buyer of that mine say, that's fine with me. But for Barrick, it's not enough. They want to make more. They don't want to keep that mine. So the mine, there's nothing wrong with the mine. They buy it, but then they say, okay, this one doesn't work. They go through Goldcorp's portfolio. They examine all the mines. They see which ones they can. Now, they've got, of course, techniques that maybe are superior to what Goldcorp uses. And they say, here's the cost. We can drive down costs on this mine. We can drive down costs on this mine. So we're going to keep this one. We're going to keep that one. We're going to get rid of that one, get rid of that one. Sometimes they make a profit getting rid of them. Sometimes they take a loss. So their projections are going forward is trimming down and getting back to that high profitable level of mining that they like to be at. But it takes time to work it through the system. But that's all well and good. But the point of it is, I would rather own Barrick that is able to move backward, forward, and make decisions and do things to increase their yield on gold and make and extract profits off it than to just simply own a mine. I don't want to own a mine, and I don't want to own gold because I'm not doing anything with it. For them, gold is a way they can make money. By having gold, they can turn that into more money. And also, when you buy Barrick, you're buying 70 million ounces of proven gold reserves. So they got 70 million ounces of gold. So 7123 million times 1,800 an ounce. So they've got $126 billion worth of gold. But that doesn't matter that it's 126 billion. What matters is how much are they going to make out of it. And if you say, okay, so now we got 70 million times, let's say they make an average of $300 extracting it. So that's 21 billion. So they are looking forward to 21 billion in profits over, let's say, 10 years. So it's 2 billion a year times well, even if the PE were 15, right? They've got 2 billion a year coming, and it's right there of profit. So with their current mines at their current levels and so on and so forth, for the next 10 years, they've got 2 billion in profit coming in, and that's going to give them a $30-something billion market cap. That's where their market cap comes from. What are the variables? The variables are the price of gold could be higher and they can make more money. Also, the variables are that the market, with their cash reserves, they can end up buying a miner at a good price and making money by buying low and selling high, which is what they also try to do during their thing. So I would rather let them gamble on gold and let them be the experts and do it. And that's my gold holding instead of sitting there and messing around holding the metal itself. I'd rather have somebody who knows how to put that all to work and build something out of it. So should we cover it was the question also. You know, if you don't think gold's going to bounce back, then yeah, cover it. But I think we're basing out and we're going to come. I think 20 is going to be a good base, and I'm not really anxious to cover yet. If we're wrong, we're wrong. You know, it doesn't change it because I still want to own gold. I still want to own it at this price for a very long time. So if we make a little bit less money selling our covers, it's not a tragedy. Therefore, I'd rather wait in case we happen to get a really good price. Wow. All right, we're really having a nice little sell-off today, huh? Down a couple of 100 points. S&P's down. Only, I mean, it's only 0.76%. It's not a huge sell-off. Oh man, was I wrong about oil? I chickened out way too early. Yeah, but I didn't chicken out. I made 1,600 bucks. I mean, what are you gonna do, right? So it's good enough for the day. Anyway, so I think I'm going to wrap it up shortly. If anybody has a question, ask it quickly. There's not much else I have to say at the moment. We're just kind of watching and waiting and seeing what kind of sell-off this is. So far, it's very mild. And look at this again over here. You know, on the day charts, this is nothing, but this can get ugly. We start, like I said, we break here and we don't have any real support all the way down. Next support's going to be here at 15.5, right, where we had a resistance last time. But below that, 15, that's a natural number for the Nasdaq. I consider all this to be an overshoot. And you look at it in this thing, that's why. All this is this. It's up, down, up, down. This will be and if I'm right, this will be the down. And we're going to go right back to 15. 15 is only in the middle right here. It's not a crazy thing. It seems like it's crazy when you look at the short-term chart, but when you look at the long-term chart, you're like, oh yeah, okay. Did that last month, nobody cared. 2 months ago, nobody cared. Because there's been no reason for this spike up. And again, we got the December 3rd, once again, we hit into the debt ceiling nonsense again, so that's dangerous. Earnings, as we talked about last week, earnings have been good, but only good compared to last year, really not good compared to 2019. There's been no tremendous improvement and nothing that really justifies the market being 30-40% higher than it was at the time. We're definitely overstretching. There's so many signs that say that we're overstretched, and I think I talked about that on Monday too. And you just got to be careful. And we're not rushing into things, and that's the thing. And that's it. That's why again, also, you know, there's not enough bargains. I'm not going to buy anything that's not a real bargain. And we talked about a couple of stocks here that are not real bargains. And that's why we don't have a lot of top trades. I don't know when the last one was. Not that we don't have any, but I mean, you know, usually I have to weed out what's compelling. I'll see, we just did SunPower too. So SunPower was November 1st, November 3rd. So we had 2 last week. We have none this week so far. And where were we? This was November 3rd. So actually, we're not going anywhere anyway. But I was just worried it was going to break out. If it breaks out, we're screwed because we won't be able to buy it again. We did IBM and Intel. We did Rocket. How's Rocket doing? I don't know. Can't find the short. Oh, there they are. Oh, no, going anywhere. See, that's fun. Pfizer. Ooh, Pfizer. Oh, that's Moderna. Oh, look at Pfizer. Holy crap. Wow, good call. Look at that. So that was October 18th. So we were around here. So we're up a nice 10% since then on that one. And Moderna's had a big sell-off. That's very unfair to them. I still don't think I like Moderna. There was just something bad about Moderna though. Patent issues. Yeah, they're in a fight with the government over the patent and so on. The government wants to give away their patents to make sure everybody can get COVID cheaply, and Moderna's having none of it. So we'll see what happens there as well. Ooh, coin took a hit today. Holy shit. Look how good they were doing. They got smacked. I don't know why, because Bitcoin's like hitting 70,000. I mean, that's crazy. All right, so that's where we're going to call it for today because my voice is a little bit scratchy. I don't want to overdo it. We're just going to watch and wait and see what happens. Okay, it's already. It is the 10th of November. I cannot believe how time is flying. I mean, because we got Thanksgiving at the end of the month. That's a big holiday thing. And then after that, you go plunging into the Christmas and New Year stuff. And boom, the year is over. And we're done with 2021. I don't know how it happened, but it did. And we survived it. And we'll see what happens. All right, but thanks everybody for tuning in, and we'll do it again next week. All right, take care, folks.